Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup world. Walmart-owned Flipkart will shift its holding company from Singapore to India as it gears up to go public in the next 12 to 18 months. Move is aimed at easing compliance and streamlining tax structures. CNBC-TV18 was the first to report on Flipkart's plan to shift domicile in December last year.
Auto-grade flat steel processing company Bosch's Metal Industries raises 43 crore rupees in a funding round that was led by Avishkar Capital. These proceeds will be used to establish a new processing facility in Aurangabad.
Unacademy cuts down on its cash burn in the core business. It's down from over 1,000 crore rupees annually 3 years ago to under 200 crore rupees this calendar year, half of what the company spent last year. CEO Gaurav Munjal took to X to say the company has 1,200 crore rupees in the bank and is in a default alive state.
The Maharashtra government orders the shutdown of stores of Ola Electric that are operating without a trade certificate. Over 100 stores in Maharashtra received these show-cause notices. As per rules, the stores cannot operate without a trade certificate.
India's proposed digital competition law likely to be put on the back burner considering concerns from US government and industry. Sources say government is unlikely to introduce the bill anytime soon due to ongoing efforts to clinch a trade deal with the US. Those were the headlines that we're tracking for you this evening on What's Brewing today. Unicus Consultech has backed $20 million in a Series C round led by Nexus Venture Partners with continued support from Sorin Investments. The funds will be used to accelerate the firm's rapid growth trajectory, launch new services and expansion. Joining us now in the studio to discuss where the firm is headed is Jamil Khatri. Jamil, thank you so much. It's great to have you in the studio again. And, congratulations on raising this $20 million.
Thank you very much, and it's always a pleasure to be on the show. My lucky show, I say.
Absolutely. I mean, the last time we spoke to you was in the studio about a year ago when you had raised these funds, right?
Correct.
So if you could sort of take us through, what the growth story has been like for you since we spoke last year, what's working, what's not, what's happened in this 1 year?
Awesome. No, thank you. So it's been a great build for us over the last 12 months since we last met. We're now 550 people across the globe, 11 offices. We have 6 offices in India, big presence in Saudi Arabia, big presence in the UAE, and a very large presence on both parts of the US coast, which is New York and in San Jose and Silicon Valley. All our businesses are firing, Arundi. So great work on IPOs in India. We've been doing a lot of work on IPO readiness, a lot of work around finance transformation in the Middle East, a lot of work globally on risk and control because that continues to be relevant irrespective of the state of the economy, and good work on ESG and climate in the Middle East. We also added a technology consulting vertical since we last met. Been doing some great work on AI and would love to talk about that, some great work on cybersecurity and overall technology. And finally, consistent with the thesis of Unicus that we're just not a services company but an asset or a product plus services company, we created a tech stack for the CFO's office, right, for the risk officer's office. So yeah, lots been going on for us over the last 12 months since I was last year.
Absolutely. So firing on all businesses is what you said. But, you pointed out that you've been doing a lot on the IPO front. But, with the market volatility, what's happening globally, where does the Indian market stand when it comes to IPOing and, what's it looking like?
I think the big picture point is, as we all know, there's been a lot of money which has gone into startups over the last decade. But when you compare exits in India as compared to what we've seen in China and other parts, we've really not had those many exits through IPOs. Everyone realizes the need for a very robust flow of new startups into the IPO system. And to your point, irrespective of the volatility over the last few months, people realize that you need to be ready. So whenever the market opens up, you then have a window to kind of list yourself. That's what we're seeing in India. Equally, just to add on to the IPO point, a very, very strong IPO market in Saudi Arabia. And in fact, there are Indian businesses who have operations in the Middle East that are effectively thinking about how do they list their Middle East operations in Saudi Arabia. So yeah, there is a lot of prep work that's going on even as the market remains choppy.
So lots of work going on there on the IPO front. But your target is to hit $100 million in revenues by 2026, right? So where are you currently at? And what's the India share? Are you on track to hit these numbers? If you could sort of give us an idea about where the globe stands versus India, especially when it comes to your business.
Yeah, so as I said last time as well, we started just 2 years ago. So we trebled our revenues in 2024. We're a calendar company. And this year we'll do $50 million of revenue, which is our third year of operation. So that sets us up beautifully for kind of, in fact, 2026 we'll be close to 100 million and 150 million by 2027. Right. So on track. The business is very well divided between our three markets. So around 40% of our revenues are in the US, 40% are in the Middle East, and the balance is in India.
Right.
And in India, we're very selectively focusing on what we do. So it's not that the market demand does not exist, but it's just very focused on things that we do in India.
So very focused work there in the India market. But you've raised this $20 million. Can you walk us through how you plan to spend this money? Do you see a shift in the way you're going to spend this money versus when you raised funds last time around?
Yeah, I think the good news is we are profitable.
Right.
And
that's always good news.
Always good news. And actually, we don't need that much capital. So we've raised, till date, we've raised $23 million. We only spent $7 to $8 million out of that. The rest of it is working capital and lying in the bank. To your point, what do we do with this capital? Three things. First is geographical expansion. We believe that tremendous opportunity in a product market fit for what we do in markets like other parts of Middle East, like Bahrain, Qatar, Kuwait, and Oman. Canada is another interesting market. ASEAN, led by Singapore, is another market. So that's one place of spending capital.
Right.
Second is we have 250 plus clients globally now. And many of these clients are saying, look, you do 4 things for us. Why can't you do item 5 and item 6?
Right.
So we're looking at valuations, we're looking at diligence and those adjacencies. And finally, AI.
Right.
We believe that a lot of work in consulting that is being done. In the first instance, we tech-enabled it, and now the opportunity is to AI-enable it. That's really where the money is going.
Absolutely, and you preempted my next question, right? I was going to say you're going to use these funds to build out Unicus AI. So how are you going to use it? How will it integrate with or enhance your existing platforms like UniQuest and Risk Universe and all of the other platforms that you have? So what are you using AI already for?
Yeah, I think in the first instance, what we did, if you remember from our past discussions, is that we took a bunch of services that were done traditionally on-site by people in the US and elsewhere and created the on-site offshore model to do it. In the second instance, we created technology assets to automate as many of the workflows as possible. And that's really what we have in Risk Universe, Reporting Universe, ESG Universe. And now the question really is, how can you further enhance it through the power of AI that we have? And that will result in 2 things. One is it will result in a different experience for the customer in terms of not having to deal with people, but having to kind of, really managing technology. And second is productivity. Right. We believe that, 60 to 70% of efforts that go in certain solutions can be AI enabled. And that's really what the journey is going to be for the next 12 months for us.
Absolutely. So big plans there, big growth plans for you, already profitable. So looking to grow in other regions as well. But Jamil, we're completely out of time. Thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey.
Thank you. Always a pleasure.
And hope to see you here next time when
on
you raise
Series
more
D.
funds.
Yeah, indeed. Thank you very much for your time.
Absolutely. Thank you so much,
Pleasure.
Jamil.
Pleasure being here. Thank you.
All right, moving on. WowMomo has raised a bridge round of funding of about 90 crores from its existing investor, Khazanah, which is a Malaysian sovereign fund, and Haldiram's Nagpur owner, Kamal Agarwal. The company is also in talks with a few HNIs and investors to take this bridge round to a total of about 150 crore rupees. It has also appointed Avendus as a banker for a larger round of up to $100 million in a mix of primary and secondary that is proposed to be raised in the second half of this year. For more on the significance of this funding round and how it is going to be deployed, joining me now is Sagar Daryani, who's the CEO and co-founder of WowMomo Foods. Sagar, thanks very much again for your time here on CNBC-TV18. As we understand, this bridge round is still in process, not yet closed. How soon before you close this targeted 150 crores, and who are you in talks with to raise that additional money?
Thanks, Ritu, for having me here. Basically, 150 is not the number that we have in mind. It's anything between 15 to 17 million USD. So, I think it should take a couple of weeks. Honestly, we have some good names backing us. It's just that, we want to take someone who can add value to the cap table. Like Kamal ji, he has deep-rooted experience in the FMCG space, someone who's been there, done that. So trying to figure out people who can actually add value to the business. In no rush, to be honest. Khazanah has put in the money and so has Kamalji. And we will take a call very shortly, but in no rush, just trying to find the right fit in the cap table, to be honest.
And is it true you're looking at $100 million kind of a fundraise in the second half of this year? And if you are, tell us why and how you want to deploy this kind of capital that you're raising.
So I think for us, we've never done such a large round before. So this will be the first large round. I think it'll be a mix of primary and secondary. I think it's more to clean up the cap table. This will be our last round before an IPO. So it's more like a pre-IPO. I think we plan an IPO between 24 to 36 months from now. So this is more to give Lighthouse an exit. They already have a part exit. So it's more to give an existing investor an exit. And I think raise enough capital to, steady the ship for the next 2-3 years. I think in the next 2 years' time, the business should start throwing back a lot of cash. So, when we hit IPO, we become a debt-free company or a debt-reduced company, and that's where we'll use the funds for. So yeah, I think it'll be more of 50 million primary, maybe 50 million secondary. We are okay with anything between 80 to 100 million. But yeah, I think it's more to, I think it's 50% of the share is secondary capital, right? So the business does not require that much cash. I think WowMomo is already profitable. I think we are figuring out the FMCG vertical, which at the moment is burning money, but then it's a new vertical. It's growing really fast, growing at 100%. And we're very confident that in the next 2 years' time, we should be cash positive. So it's more to give exits. It's more to have enough capital, pay back your debts, and in 2 to 3 years' time, execute, put your heads down, perform, deliver, not to get distracted, and go out there and hopefully have a wow, have a wow IPO if we can.
And when is that WowMomo IPO, Sagar? What is the timeline that you're working with?
See, you can't time the markets, but anything between 2 to 3 years. Again, it depends when the elections are. I think 28, 29 is the year when the elections are there. So we'll figure it, but we want to be IPO ready in 24 to 36 months. When we time the market, when we hit the market, I think it'll be a decision we'll take depending on the external circumstances. But yeah, we're very clear in our head that, we want to get to a, 1100, 1200 crore top line. We want to get to 100 crore EBITDA and then, aim for IPO. So, for a company like us growing at 35, 40% year on year, I think these are decent margins, good margins. And if we can meet our numbers, if we can walk the talk, I think kudos to the team and to our patrons to be able to get there.
All right, 2 to 3 years for an IPO that you're looking at. You briefly mentioned WowMomo's is profitable, but what about the overall business? You closed the current year with about 640 or so crores of revenue, and now we understand you're targeting almost 900 crores in the coming fiscal. What will drive this growth?
So I think the 640 crore will definitely jump to 900 crore. If you look at it on an ARR perspective, we are already an 800 crore business. And we're opening 250 new stores. I think the major fundraise is to open these new stores. As a business, we are a going concern, right? I mean, we just need to reduce the growth and, we can become cash positive. So it's more about, plugging and opening these 250 stores. That means on an average, we open 21 stores a month, which is almost opening one store every working day, right? So you need capital to fuel that growth, and that's why the raise is there. But net, I think it's more to do with FMCG growth. It's more to do with the QSR growth. We have a new vertical in Horeca where, we are selling momos to 5-star hotels. We are selling momos to, brands like Zepto, etc. So I think it's a big runway that we have, and we should touch 900 crores for this year, which will be almost a 45% growth as compared to last financial year. So I think we have our plans in place. I think we're doing the right thing at the right time. Personally, I think we've built a very, very strong team. We have a separate CEO for FMCG, a separate CEO for QSR. So the business is completely on a autopilot mode where we just need to go out there and deliver. It's only us who can make this big, or it's only us who can spoil this. So I think we don't want to be party poopers. I think we want to go out there and, give in our best and leave the rest to things to happen. I mean, you can't control external factors. There has been a major silent slowdown over the last few months. USR has seen negative same-store sales growth. Fortunately for us, I think if I compare it to the listed peers, we've been plus 4% for the whole year. So I think we've really come back well from July. So we want to keep that momentum going.
All right. We see you already comparing yourself to the listed peers. We'll hope to see you in that space in the next few years. But quick word on your FMCG vertical and, of course, the newly launched hotel, restaurant and catering arm. What should we expect? What are your plans in terms of scaling this year? What will be the priorities?
See, we started FMCG 28 months back, right? And in 28 months, we've become a 5 crore monthly business very proud of the team. I think when we started frozen momos, we were zero and the competition was at almost 5 crores. Today we are at 5 crores and the competition hasn't really grown much. So I think we've captured a lot of market share. And very proud of the way we've done it. Personally, I think for us, it's about, being category creators. So we just launched Kappa noodles where we have a Kappa Khawswe, a Kappa Thukpa. So we don't want to be a Me Too. We want to create new categories. We have frozen smileys that are coming into play. So, chicken and cheese smiley, chicken cheese smileys. In momos, we've done the Korean range of momos. We've done the kurkure momos. So I think lots of innovation happening in the product space. Very soon, I think by Q4 or by early beginning of next financial year, we're going to get into our own range of sauces, spices. I think the WowMomo sauce is, it's in high demand. Customers come to our store, then they ask for extra.
Okay.
So I think a lot of traction happening in the NPD space in FMCG. So I think it's a big vertical market. We want to be focused on Oriental, and that's where our focal point will be.
And we wish you the best with that, Sagar. Thank you very much for your time here today. Thank you.
Thank you, Ritu. Thank you for having me.
On that note, it is time for us to head into a short break. But coming up next, an exclusive conversation with the co-founders of IPO-bound Ather Energy. The EV maker expects strong growth to continue as it focuses on cutting costs, sourcing locally, and strengthening supply chains further. Stay tuned for that conversation.
Of being a part of country's EV revolution, Ather Energy is now gearing up for its biggest test yet, the IPO. Joining me now are the founders Tarun Mehta and Swapnil Jain. Thank you so much for joining us on CNBC-TV18.
Thank you.
I think the first question when an IPO comes on the block is a very obvious one, which is path to profitability. Is there a realistic timeline on breaking even?
So, path to profitability is basically two levers, your unit economics and then scale, which is the operating leverage. I think if you see our updated numbers till December, you will notice we've done a tremendous job on improving our unit profitability, gross margins. They've gone from 9 to 19, so they've scaled up really well. And this is down to some amazing work done by our teams on value engineering and a great job done by our sales system on the right kind of SKU mix and product mix overall. The second part of this equation is scale. Again, on scale, you will notice we've grown very healthily in the last 9 months, and this entire year looks like a great growth year. And what's ahead of us on both these axes is a lot of potential cost improvement on the back of our new platform, on the back of the transition to LFP batteries. And on scale, there's a tremendous lever of new stores and expanding our distribution that's ahead of us that we're very excited about. So put these two parts, we've done a good job with both. And there's a very strong outlook on both, which is why we think the path to profitability is at least clear now. And you will also notice that EBITDA has improved quite a lot in the last couple of years.
But with FAME 2 subsidy hitting pretty hard, the entire EV sector, especially the two-wheeler sectors, the two-wheeler market, how do you sort of future-proof yourself with these policy changes? Because policies are dynamic in this sector yet.
I think the bad thing and the good thing that's happened with subsidy is that the bad thing is that it's come down, and the good thing is that it's come down. So now the overall reliance on subsidies has reduced for the industry, so the overall impact is not that high. Like 2 years ago, this would be a massive lever. If anything happens to them, this would change our financials massively. But now we've come to a point where subsidies are going to soon become something like 3% of the revenue. So while that makes our job harder, but in a way the company and the industry is better prepared for it. What can you do to better prepare for it? There's a lot of engineering. Our teams have been focusing on taking cost out. In fact, I think that continues to be one of the largest focus areas within product development overall. A lot of work on supply chain resilience and domestic sourcing. So those are things we've done to, in a way, future-proof ourselves against further subsidy reductions.
One of your biggest backers is, of course, Hero MotoCorp. How do the synergies work here, considering a legacy player is backing and betting on an up-and-coming company and a sector for that matter? Where do you draw the line? How much of, what is the sort of share percentage, if there's any?
Share percentage of?
If there's any like tech percentage that you're sharing with them, or are you helping them out with anything?
No. Ather and Hero are two completely different platforms, if I were to describe them that way. They're very unique and strong advantages that Hero as a business has with their motorcycles, with their now expanding international, with their focus areas. The customer is very different. With us, our product, our DNA, our sales system, our customer focus, they're very different. So it kind of makes sense for us to build these businesses out differently instead of trying to find synergies. We've looked at synergies, and there are a few, like in charging infrastructure. But at the product level, at the sales level, we've realized it's better to build businesses differently. Hero has been a fantastic partner in our journey over 8 years. They've been our biggest backer, and Dr. Munjal has been a great supporter over the years. But ultimately, the business has to be built out.
I'm sure you get this question a lot, because with the release of the DRHP, they're not participating in the OFS at all and only going around ramping up their stake in the company. What's the future like? Is there an acquisition on the cards? Is there a merger on the cards? What would the future be like, or is it never a possibility?
Honestly, if M&A was the way forward, us spending all this time taking the company public is a bit of a tangential journey then. It would be far better if you want to pursue that path. Instead of us spending so much time with them building their EV business out, us building our EV business out, would actually be a fairly counterproductive exercise in a sense.
Top tech features of Ather that sets you guys apart from an Ola or any other EV in the industry?
So actually, we are all along our focus has not been about paper spec. It has always been about the depth of every feature which we offer. May it be the auto hold feature, may it be the maps. For example, we've been very clear that we will not move on to some other maps platform, because maps is not like a checkbox of a feature for us. Google Maps works best for customers, and that's why we will provide only Google Maps. So it's similarly on auto hold. It's not about, okay, can your vehicle hold, but how long can it hold? Can it hold for a half a minute, or can it hold for 2 minutes? Can it hold with one rider, or can it hold along with the pillion for 2 minutes, 3 minutes, 5 minutes of sort? So all our features, auto hold, or even a Bluetooth stack where your phone and your vehicle and your helmet sort of pairs together. We believe in depth of features than just the checkbox of features. Ecosystem is always going to be our strong focus, because that's inherently an EV enables that, and we also believe that we have to stop looking at just vehicle and look at there are a lot of ecosystem products around the vehicle, and they really enhance the ownership experience of the product.
This IPO is coming at a time when not just the market is struggling, but also EV sales are going through a slowdown in the country. How do you peg this double whammy of a situation?
I think we get too distracted, and it's funny you talk about the markets and EV sales month on month, because I think we get too distracted with this myopic view of monthly numbers. So markets in October are the greatest market ever, markets in Feb are bad, and last week now was the best week ever, and everybody gets too distracted with it. Even EV sales, if you look at an annual level, or even if you look at a quarterly level, have been on a great path of growth. FY24 looks like a healthy amount of growth over FY23. Calendar 24 was a short amount of growth over calendar 23. So we shouldn't read just weekly or monthly numbers. See how the entire picture is emerging. Tier 3 towns, Tier 2 towns in India are electrifying at a rapid pace. Scooters continue to win over motorcycles. Electric scooters are growing much faster than than petrol scooters. I think there's a tremendous area of growth. I think the outlook is beautiful over the next few years. The TCO makes a phenomenal amount of sense for an EV buyer with a scooter. We are focusing on the premium and upgrading customer, which we believe is the strongest growth category over the next few years. And for us, particularly, the story is very, very exciting because we've just launched a second product which has seen tremendous response with Ather Energy. So obviously, it's going to drive a lot of growth in the near term. EL platform is coming in very, very soon ahead of us. That's going to drive a lot of future products for us. And then finally, distribution. There are hundreds of cities where Ather is still not present. Opening our stores there finally this year, next year, is going to drive a lot of growth. So I think we are bringing our issue to the markets at a time when we've proven our brand with Ather 450. We've shown the promise with Rista. There is the future promise with more distribution and the EL platform, the new platform. And the industry continues to grow at an annual level very healthily. We love the timing.
But what are you, if I could frame this better, when we speak of markets, we saw Ola come down from a peak of $7 billion to now almost 65% from its peak ever since it got listed. Markets haven't changed much. And we saw that with your valuation also coming down from 20,000 to 14,000. Where is the confidence coming from, and are you exactly confident to go forward with this?
We are not trying to time the markets here, and actually I will say the same answer all over again. We're not trying to time the markets here. Pricing is ultimately a factor of where the larger indexes are and where the larger market is. What we believe is, what we've seen is tremendous amount of demand and excitement for our brand and our company. We've been building it solidly for the long term. There's a solid view, there's a solid focus on profitability. If you notice our EBITDA numbers quarter on quarter, we've improved them significantly. We're not a company that's just trying to grow top line at the expense of every other number. In fact, many of you have asked me the same question. Why not just sell more products at a lower price? We've not done that because we also have kept our eye on profitability. Ultimately, I think the market will reward strong, profitable, sustainable growth with a company with high governance, which is what we're trying to build at Ather. So we're very bullish on market, on our long-term prospects. And the pricing, exact timing of the market, I think that's, nobody can predict that. It's fine.
Thank you so much for joining us today on CNBC-TV18, and good luck for the IPO.
Thank you.
Thank you.